Hughes oil rig count showed that active oil rigs were reduced by 1 in a sign of failure of the demand side of the US oil market to widen. Furthermore, we note that on Tuesday, API and EIAs reported a drop of US oil inventories. Practically all three data related to the US oil market that were released since our last report aligned to suggest that production levels in the US were not able to catch up with the aggregated oil demand. Hence, given the drop of oil prices despite the tightness of the US oil market, we should seek the fundamental reasons for the drop of oil prices elsewhere. Nevertheless, should we see in the coming week the indicators continuing to suggest that the US oil market remains tight, we may see the weakening of oil prices being clipped or even reversed. One of the main concerns among oil traders seems to be the prospects of China's oil demand. As per Bloomberg, oil imports and refinery runs from China in the current year have tended lower than in the past year on weaker fuel demand amid sluggish economic growth. At this point, we would like to note that the economic performance of China remains worrying. At the same time, we note that the PBOC proceeded to reduce the interest rates for short-term lending by 20 basis points as well as the 1- and 5-year lending by 10 basis points in an effort to boost economic activity. Overall, should we see further signs of difficulty for the Chinese economy to recover, we may see markets' expectations for a deterioration of Chinese oil demand intensifying and thus exercising bearish pressures on oil prices. Furthermore, we also note that the manufacturing sectors of Japan, Australia, France, Germany and the US suffered a contraction of economic activity for July according to the preliminary PMI figures released yesterday. Should we see further signs of easing economic activity in the industrial sectors of the pre-mentioned countries, we may see bearish tendencies being exercised on oil prices as market expectations for oil demand in international levels growing further. Also, we note that the negotiations on a possible deal for a ceasefire in the Gaza conflict seems to be nearing its end. Existing gaps are to be discussed by US President Biden and Israeli Prime Minister Netanyahu. Any possible progress towards a possible lasting ceasefire could allow oil prices to weaken further as market worries for the supply side of the international oil market could ease. On the flip side, should the negotiations fail to achieve a breakthrough and tensions start to escalate, or the opening of a second front in the Israeli-Lebanon border could drive oil prices higher as worries for a tightening of the supply side of the oil market. WTI's price doubled since last week, breaking consecutively the 80.25 and the 76.70 support levels, both now turned to resistance. The commodity's price action intensified its downwards inclination since our last report after a relative stabilization which served mostly as a confirmation of the downwards movement. We tend to maintain a bearish outlook given also that the RSI indicator is nearing the reading of 30, highlighting the strong bearish sentiment for the commodity's price among market participants. On the other hand, we have to note that the WTI's price action is breaching the lower boundary of the Bollinger Bands, which may slow down the bears or even cause a correction higher. Yet we would treat any correction higher as just a mere correction as long as the downwards trend line remains intact. Should the bears maintain control over black gold's price, we may see WTI's price aiming, if not breaching, the 72.40 support line. For a bullish outlook, we would require WTI's price action to break the 76.70 resistance line, continue higher to break the pre-mentioned downwards trend line, and reach, if not breach, the 80.25 resistance level. Thank you for joining us today as we navigated through the dynamic world of financial news. From all of us here at IronFX, we wish you a solid trading.